What's up, y'all? I'm gonna ask you guys a question. Last week, did you pay attention? If not, let me update you on some things. So, we had the new Fed chairman, Kevin Walsh, deliver his first speech as the new Fed chairman last Wednesday. And it was hawkish, simply meaning they plan on leaning towards rate hikes. The Fed's held rates steady at 3.50% through 3.75% and unanimous vote. But the dot plot, which is the chart showing where each Fed official thinks rates are headed, flipped from projecting a rate cut to now showing 9 of 18 officials expecting at least one rate hike by the end of the year. And what that means is the projection jumped from 3.4% to 3.8%. And Wall Street's reaction to that, man, was absolutely amazing. Absolutely amazing. The S&P 500 suffered its worst single-day Fed reaction under a new Fed chair since 1994. But check this. Did you peep how the NASDAQ fell over 1%? Oh, you didn't peep that part, did you? Well, the next day, the market actually rebounded relatively quickly. Why? Because the same week brought us a formal U.S.-Iran peace agreement, simply telling us that they're going to be opening the Strait of Hormuz. And then that sent oil prices lower, giving folks a reason to look past Walsh's hawkish tone. Well, what does all of this actually mean? Well, the market is currently caught in a tug of war between rising rate hikes and falling geopolitical risk. And the tension is exactly what is going to drive price action this week. So make sure you are paying attention. Now peep this. The Philadelphia Semiconductor Index, which is ticker SOX, well, that actually rose as the even broader market sold off. How crazy is that? And all that did was confirm that folks are still seeing the AI build out as a structural trend that operates independently of the short-term Fed noise. Now, that divergence between the chips holding strong while the broader index wobbles, now that's a pattern folks should be paying attention to this week. So with Walsh's new style of communication, which is now a new institutional variable to track, he deliberately declined to submit his own dot plot projection, y'all. And the fact that he cut the Fed's post-meeting statement into a summary, man, listen. When we had our guy Jerome, right, we came out with that purple tie. We already knew what time it was, right? He gave us a more detailed communication type of style. And this guy, Kevin Walsh, well, he ain't playing, y'all. He is not playing. So now folks have a less forward guidance to work with than what they were used to, which by itself tends to increase volatility. Why? Because the market has fewer data points to predict the Fed's next move. Now, the bottom line is this. Whoa, I almost fell. That's funny. The bottom line is this. This week, folks are recalibrating for a higher for longer rate environment while simultaneously cheering reduced geopolitical risk. And the push-pull dynamic combined with the quieter, less predictable Fed simply means that the market is suffering from a severe... Come on, what's all that noise? Sorry about that. The market is simply suffering from a severe disorder called SHDD. That's SHDD, and that is severe headline dependency disorder. That's what that means, y'all. So if you hear that from someplace else, forget it, we're gonna scratch that. But anyway, it simply means that it's the most likely setup that the rest of June, that is gonna be the tone for the rest of June. Sorry, that noise in the background threw me off, and I'm not re-recording this, all right? So I'm gonna repeat that part again. This week, folks are going to be recalibrating for a higher for longer rate environment while simultaneously cheering reduced geopolitical risk. Now, that's the part we all need to be paying attention to.